in practice.
Hello everyone, welcome to our Egyptian online seminar group. First, confirm to if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming here Professor Gaoqing Zhang. Gaoqing Zhang is a professor of accounting at the University at Carnegie Mellon University. The real effect of accounting measurement and disclosures, particularly in the financial industry and the design of accounting standards and disclosures regulation. He currently serves on the editorial board of the Accounting Review. His research has been published in top-ranking journals in accounting, including Journal of Accounting and Economics, Journal of Accounting Research, Management Science, and the Accounting Review. Now we will start our seminar with dear Professor Gaoqing Zhang.
Thank you, Mohammed. And it's my absolute pleasure to share with our audience my research. And I also appreciate the opportunity. And I heard about your online seminar from my friends, and they all say it's a good forum for exchange of research ideas. So I'm really looking forward to your comments and feedback on my work. So for today's presentation, I will talk about what we do regarding an empirical measure. In this paper, we theoretically derive an empirical test, a measure of the information in accounting classification. And as I will show you, when we try to derive and analyze this measure, we heavily rely on information theory, in particular, a notion called entropy. Therefore, we are going to term for our convenience, this measure of information of accounting classification as accounting classification entropy, or what we call ACE, ACE. So the ACE measure is something I will tell you today. Okay, but I don't want to get too far ahead of myself. So you may say, why do you want to do accounting classification information measurements? Well, let me first motivate, right? First of all, I guess it's safe to say classification is just so fundamental to us in our process of perceiving, communicating and interpreting information. It's the way for us to learn the things in the world around us, right? Classification is such an important tool. And if you think about classification accounting, it's even one of the defining features of accounting. For example, consider this quote by American Institute of Accountants in 1941. They define accounting as accounting is the art of recording, classifying, and summarizing in a significant manner in terms of money transactions and events, and interpreting the result thereof. So classifying is one of the defining features of accounting. And on top of that, if you think about classification, well, the purpose of that is to convey information. And measuring that information, therefore, is essential for us because we want to understand whether classification has achieved its desired purpose of providing information. However, in my opinion, I think in the current literature, the question of how to summarize and measure and quantify information in accounting classification is so far underexplored, and we try to do something in that direction. All right, but let me give you something more concrete to fix ideas, because you may say, what do you mean by accounting classification? What do you mean by information in it? Well, to illustrate, let's consider this example of Silicon Valley Bank, SVB, a bank that has attracted a lot of attention in the past few years, right? So this is the asset section of SVB's balance sheet, right? For the past 3 years, 2020 to 2022. So we have 3 columns of data of assets here for every of the 3 years. And clearly you get lots of information because you get, for example, for the year of 2022, you get quite a number of signals in terms of asset balances. In 2022, for the cash, you have SVB has about $13-14 billion of cash, has about $26 billion of available for sale securities, and so on and so forth, right? These are basically a vector of signals I'm getting about SVB's assets, right? They ask a question like, what I'm learning here? Well, without loss of generality, you can decompose all these signals into 2 parts. The first number you get is just the total assets of these assets, right? You can say, hey, this is the total assets I have for SVB for all 3 years. And you learn a lot about it in terms of total assets. For example, if you look at the total assets of SVB in 2020, it has about $115 billion of assets. And then in 2021, SVB total assets ballooned because of a lot of mergers and acquisitions to $211 billion. So we had a huge growth in total assets. Then from 2021 to 2022, you had a pretty modest, even negligible growth in total assets, right? That's something you learn about total assets. That's the first dimension of information you're getting. But on top of that, what else? Well, turns out if you observe all the asset balances for the column of assets, you not only just learned assets, you also learned classification. That is how the total assets is classified into all these different assets, right? I know among the total of $211 billion of assets in 2022, about 13 billion was classified into cash, right? And to further illustrate the classification information, let's convert SVB's assets into a common-sized balance sheet. That is, I restate the balance of every of the assets here into percentages in terms of total assets. So you can see the classification information in real action. For example, in 2022, you can see, hey, cash and cash equivalent accounts for about 6.5% of the total assets, while available for sale securities accounts for 12.3% of the total assets. So these are how assets in terms of percentages are classified into different assets. But now the question is, clearly you are learning a lot from these signals, these fractions. But the question for information is how to measure these classification information contained in common-sized financial statements. Do we learn a lot about classification based on these fractions, or do we learn very little? That's the question we want to go after in this paper. We will try to develop a measurement framework that can represent accounting classification. And within that representation of accounting classification, we want to produce a measure that is a summary of the information in these classified account numbers. And we want to make sure this information measure is very simple, so people can easily use it. It's very transparent, so there is no bells and whistles. You will all understand what it is. And then it's also flexible to use. So you can apply this measure of information to a context of your choice, right? So that's the measurement question we want to go after. All right, so you say, okay, that makes sense. If you agree with me, you say it makes sense to measure classificational information on financial statements. What do you want to go from there? Well, if you want to answer a measurement question, obviously you want to start with something, right? You want to start from a foundation. So what's the foundation that we're going to start with in pursuing this measurement question? Well, a natural candidate that I'm thinking of is go back to information economics framework, right? Because I'm a information theorist, information economist by training. And if you recall the history of accounting research, this line of work in information economics and their applications to accounting has been phenomenally successful, led by Professor Joe Dansky since the 1960s. All right, so let's use information economics framework for a second and think about whether we can adapt that to build information measures of accounting classification. Well, how can we go from there? Well, let's go back to our PhD class 101, right? If you want to do an information economics framework, well, you need to specify a decision-making under uncertainty framework. You're going to bring back your favorite econ subjects such as state, action, outcome. You need to define some utility functions because that's going to be how people make decisions. You're going to put probabilities over states, and then you can convert accounting information as some particular partition of the state space. Of course, you can get even fancier. You can say, hey, this is just single person decision making. You can bring in multiple player, like a game theory. You can make things fancy, like you have timing issues. You can have higher order knowledge, so on and so forth. Of course, I don't want you to go there because my point is, once you see all these sort of bells and whistles under information economics framework, you probably will see where I'm going. It's not very simple to get a simple measure of information or classificational information using a decision-making or information economics framework, because you have to specify a lot of things that potentially not even observable or abstract to many empirical exercise. More importantly, there's a fundamental blow to this approach, and that comes from the master himself. So Joe Dembski in 1973 had a famous result called the general impossibility result. That result said it's generally impossible to get a general information measure that independent of the state's action, outcome, or utilities, or any decision-specific context. So it's impossible if you go with the information economics framework to get a universal measure of information that can be useful in many, many contexts. Then that goes against our intent, because we want to provide something simple and flexible and can be generally used in many contexts. Therefore, this information economics tool, while it's beautiful, it's very successful, it just won't work for us. So what do we go from here to get our information measures? Well, we dare to take a different path from the path that Joe has laid out for us. And in this research, we tried to take the following approach. We want to answer the measurement question by applying information theoretical tools to analyze the representation of accounting classification. So you can probably see in our measurement exercise, there are two essential elements. We want to think about the representation of accounting classification. Then given that representation, we want to apply information theoretical tools to analyze it so that we get a measure of information out of it, right? So let me give you some thoughts on why would I go this way, right? First of all, why representation? Why you want to represent accounting classification? Well, our attempt to represent accounting classification can be tied back to the classic accounting measurement work back in the 20s. In those days, accounting theorists construct analytical models to represent the accounting process of classification and measurements. And once they get representation, they can then evaluate the information role or information value of accounting numbers by just comparing their properties with some preferred benchmarks. Such representation approach or measurement approach obviously was pioneered by Professor Yuji Ijiri. This is a picture of Yuji in 1975. And if you have not read that book is called Theory of Accounting Measurements, which laid the absolute foundation for this measurement approach. And I'm a CMU faculty and a former CMU alumni, PhD students. It's just given me tremendous proud to be able to tie some of my work back to the work of Yuji. So that's why I go for representing accounting classification in the tradition of classic accounting measurement work, right? So that's the first element. But then we're not done yet. You might say, hey, you can get some representation of accounting classification. But remember, you want to measure information there. How are you going to measure information in accounting representation, right? How are you going to measure that? Well, we are going to borrow a tool from information theory pioneered by Claude Shannon in 1948 that will help us to analyze this accounting classification representation and help us to analyze and measure the information in those classifications. And to give some background information about information theory by Claude Shannon, this is probably one of the highest achievements in our history in the past 70 years. Shannon was the first one to develop a theory to analyze the transmission and communication of information. And this is the original paper where he applied his theory to analyze the transmission of electric signals. And later on, this method of analyzing information has been widely applied to economics, to statistics, to physics, and most recently to AI and machine learning. In every single application of entropy or information theory, it has achieved tremendous success. That's why it gives us hope that if we apply information theoretical tools such as entropy to analyze accounting classification, it may give us a measure of information. Right? So I know that was a lot of things I threw at you. Now let me just recap before I go to the details, right? So what the question we want to go after in this paper? Well, we ask a very simple question. We have accounting classification like the SVB common size balance sheets you have seen. And our exercise is how to measure information in those classification. And what's our idea or what's our answer? Well, we try to develop a measure of those information in accounting classification by applying information theory to accounting classification representation. That's our idea. All right. But before I tell you the details, what exactly we did in producing that empirical measure of accounting classification information, I want to acknowledge a major predecessor to our research. Right? We wish we were the first one to apply information theory to financial statements. Well, we're not. Back about now this is more than 55 years ago, economists and statistician at University of Chicago, Henry Thiel, was the first one to apply information theory to financial statements. Then his students, one of the most notable one, Baruch Lev, followed and also did some work in the 70s. And in Thiel's initial application, the application was almost like an example. So he applied entropy concept to analyze the financial statements of the Ford model for 2 years, 1964 to 1965. But remember, that was just 69, right? So well, computers and statistical tools were pretty limited. All right, so that's what Henry did. And 55 years later, we try to extend Thiel's work. And we also try to apply information theory to analyze accounting classification, but we extend his work along 2 dimensions. First of all, we propose a theoretical framework that generalizes entropy measures to any positive elements, such as the fractions of a financial account balances, even though these measures cannot be interpreted as probabilities, because you may know that entropies, when it's invented, it was mostly applied in a probability context to probability distributions. And we show you do not have to limit yourself to apply entropy to only probabilities. Right? That's our theoretical generalization. And on top of that, we then apply empirically the derived entropy-based information measures of accounting classification to larger scale of empirical analysis of measure construction, analysis, and applications. So we no longer limit ourselves to just one firm and 2 years, as Henry did, Thiel did in 69. Right? So that's our extension to Thiel's work. Right? With all of you, that's my introduction. Now let me sort of go to the meat of the projects, right? What we exactly did. Remember, our idea was trying to analyze information theory concepts to analyze and quantify information in accounting classification. So to keep us on the same page, right, I want to give you sort of a quick introduction of the information theory concept that I will be using in my analysis. The 2 information theory concepts will be used, entropy and relative entropy. Let me give you some sort of a quick definition of them. So the first concept that I'm going to use in my analysis is Shannon's entropy. So what is entropy? Entropy is defined on a probability distribution. Say you have a random variable x, and the probability of distribution of that is p. And what's the entropy? Entropy, hx, just equals log p minus, so it's a negative log function, then weighted by the probability itself. Well, that's an easy formula to understand, but what does it tell us? Well, there are 2 interpretations of entropy in modern information theory. Number 1, entropy measures how uncertain or disordered my random variable is. That is, if my entropy measure hx is really big about x, that means x is really uncertain to me. I don't know much about it. It's just all wild. It's an uncertainty measure. Equivalently, there's a second informational interpretation of entropy. That is, entropy measures the total amount of information I need in order to fully resolve or fully communicate the value of that random variable. Intuitively, you may say, hey, if you deal with a very uncertain random variable, you need more information, a lot of information to fully resolve that uncertainty. For example, think about x as a stock return. And the stock return obviously is a random variable to us. We don't know how it's going to be distributed. If the random variable is the stock return is super uncertain, and if I want to resolve All the uncertainty about it, well, I need a lot of information about that stock return. You have to tell me a lot to get to know it. And entropy captures how much information you need to understand that random variable, right? So the uncertainty measure is also an information for resolving the uncertainty. And the second concept related that we're going to use also is a notion called a relative entropy. Relative entropy is also called KL divergence. Its definition is basically a measure of the distance between two probability functions, Px and Qx, right? And this is the formula for calculating it. So it's like entropy. We define relative entropy as the log difference between the distribution Qx and distribution Px, but then we weighted that with the probability Qs. But despite the formula, what does relative entropy tell us? It tells us two things. First, it tells us the information or divergence between two distributions. Say you start with a reference distribution P, that's your belief about some random variable, and then you want to describe an additional distribution on top of that, how much additional information you need. Well, that's your relative entropy. A second interpretation of relative entropy is in Bayesian inference. Suppose, again, going back to my stock return example, I don't know much about stock return, so I form some prior belief about the distribution of the stock return. And say my prior belief is P. And then I get some information, maybe some accounting disclosure about the firm, so I can assess a more precise distribution or posterior belief about that stock return. You ask a question like, hey, from your prior belief to your posterior belief Q, how much incremental information you get? Well, the divergence measure or relative entropy, DQP, tells you the incremental information you get from going from the prior P to the posterior Q. That's the interpretation of relative entropy, right? So those are two quick introduction of the information theory concept. But more importantly, let me apply them now to accounting classification, because we care about information in accounting classification. To illustrate, let's consider the following theoretical representation of accounting classification. Very simple, right? Think about the balance sheet of a firm's assets, like the example of SVB's assets that I have just showed you, right? Say the firm's assets has a number of assets, so you can think of the firm may have current, non-current assets, and then within current assets, the firm can have cash and non-cash assets. Within non-cash, you can have inventories, account receivables, and so on and so forth. And as in my SVB example, the information you get from those assets are the balances of those assets, right? You get a bunch of signals about the balances of those assets. You can call them as X1, X2, Xn. Those represent the balances of those assets. And as I said, for all these balances of signals, what's the information you can learn? Well, you can probably decompose them into two parts. One is the total balance, which is basically summing up all the individual asset balances, Xi, to a total capital K. And that tells you just the total asset value. That's a useful information we have seen in the SVB example. But on top of that, think about the common size balance sheets. You also get some classification information, which is a small x. Small x is essentially just the fraction of each asset's balance in terms of total. So small x just equals a big X, the balance divided by the total, the fraction. And as I've explained in my SVB example, those are essentially classification, right? We classify the total of the assets into different buckets of assets. And our exercise to try to say, can we get information of this classification? And this is our problem. We try to propose a measure of this classification information. Let's call that JNX. That can have some appealing properties, right? We want something nice, some good measures of the classification information. And you may say, oh, there are a lot of measures I can think of to summarize the information in classification information. So what kind of appealing properties you want? Well, there are three appealing properties for a measure that can be implied in information theory. So let me explain them to you. The first appealing property for an information measure that I can think of is something called normalization. What does that mean? let's consider the following example. Let's think of the simplest classification that you can think of. That is, I just divide my total assets into current and non-current assets equally. I just split $1 of assets into half and half, into two buckets of classification. Arguably, that's like the simplest classification you can think of. And the measure of that, by our notation, will just be J2, 1/2, and 1/2, right? And normalization says, given this is the simplest classification you can think of, let's call that 1, right? Let's say that's measure, that the amount of information here is 1, because that's just simple normalization. You can normalize that to be anything, but 1 has a simple meaning. So let's do that. So what's the second appealing property? The second appealing property is a property of continuity. That is, well, if you start with the half and half classification, the simplest, now you change the fraction x that you want to classify into current assets. So you put x into current assets, and therefore 1 minus x into non-current assets. So that classification gets slightly more complicated than before. Well, then what's your information measure? It's J2 x 1 minus x. This measure, if you think about it, you want to be smooth, to change very smoothly in terms of the fraction x. And you want some sort of continuity here. And that's the second assumption you want to make. You want to make sure the measure changes continuously with the fraction of assets you classified in one of the categories. So let's keep that property called continuity, right? So far, normalization and continuity are basically some sort of relative technical requirements. What's the third property that we feel are intuitive or appealing? The third property is called a grouping property. What does that mean? Let me explain that to you. This one is a bit subtle, but this one is also essential to our measure. Let's say you start with the two classification, current assets versus non-current assets. And now you want to improve that classification by separating current assets into cash and non-cash, because you want to have a third category of classification so that you get better classification. And let's think about this following example. You put 1/3 of current assets into cash, and you put 2/3 of current assets into non-cash. What do you get here? Well, the new classification you get will be, you have 3 assets now, right? You have cash, non-cash, and non-current assets. You have 3 categories. And now the new classification will be 1/6, because you put 1/3 of the 1/2 current assets. So 1/3 times 1/2 will be 1/6 into cash. And you put 2/3 of the 1/2 current assets into non-cash. So 1/3 of that will be non-cash. And you put the remaining 1/2 into non-current assets. So this is a new classification. Obviously, intuitively, we say, hey, this new classification should be more informative than the prior classification of just 1/2 and 1/2, right? Because you have more classification, it's finer, it's more detailed, it's more granular. But the question now is, how much information you have gained over the prior classification? Well, intuitively, we'll say the information you gained should be proportional to 2 things. Number 1, this should be proportional then in the information that you get from classifying current assets into cash and non-cash. And how much you gain by classifying current assets into cash and non-cash? Well, that's just J2, 1/3 and 2/3, right? Because you separate current assets into cash and non-cash, 1/3 of going to cash and 2/3 going to non-cash. This is the information you get from that additional classification. And the information I get should be proportional to this. And second, the information I get should be proportional to relative size of the current assets. If I classified lots of current assets, I should get more information. And how much current assets that I have classified? Well, that's just 1/2. Now I put everything together. The left-hand side of the equation is the information I get from the newer classification over the old one, right? This is how much information I get from the final classification. How much do I get? Well, this information gain, as I just said, should be proportional to the size of the assets that you have reclassified and the information you get from that new classification, right? That's what I mean by grouping property. So far, seems intuitive. If you reclassify, you get information from that additional classification, and the classification benefit or information is bigger, we will classify more. But now, if you agree with what I said, I can show you something truly amazing. That is, if you think about classification of X and satisfies normalization, continuity, and grouping for that information measure, you may say, hey, there could be a lot of them. Well, no. Information theory will tell you there's a unique measure of information that satisfies all three properties, which seems intuitive. And the only measure, you guess what? Is the entropy of the classification. So in that sense, my measure of classification is the entropy over the classification. And that's the main empirical implication here. If you want to measure classification of information on my balance sheets, the way to go seems like from information theory is go for accounting classification entropy, or ACE. ACE. I really like ACE name, so the takeaway for today's talk is go for ACE. And the calculation of it is so simple. You just take the log of the fraction of the assets weighted by the asset fraction, add them up, you will get your information measure. The bigger the ACE measure, the more information from the theory there is in accounting classification. Right? But before I go to empirical test, I want to tell you another measure, right? So you get a measure of classification information, that's my ACE measure. But if you think about it, that measures the total information in accounting classification, because there's no reference point. I'm not comparing this classification I'm getting now to any prior classifications. But you think about it, in many empirical tests, you don't just want a total information measure, you also want some incremental information measure. What does that mean? That means whenever there's an arrival of new classification, say a new balance sheet arrived, you want to ask a question like, how much additional information, how much news, how much surprises or incremental information I'm getting from that new classification relative to some sort of prior expectations? Because we all gonna have some forecasts or expectations about how the assets should be classified. And when the new classification arrived, we want to ask a question like, how much incremental I'm getting? That's an incremental measure. Can we do a measure of that? Well, that measure can be easily calculated. For example, think about you can have about the unasset classification example. Your prior expectation of that says P is a fraction of P1 to Pm for all these unassets. And you get some new classification arrived. This is what you observe for a new balance sheet, which is Q1 to Qm. And on the ACE measure, my classification entropy measure, the information of classifying Qi fraction into asset I is represented by the log function log Qi weighted by the relative size Qi. That's my ACE measure. You want to ask a question like, compared to your prior expectation, how much additional or incremental information you get? Well, you just take the log difference weighted by the size of the assets. That's your incremental information, and you do some simple math, take the log difference, which will be a log Qi divided by Pi, and that's your incremental information. Now you can probably see I talked about a relative entropy to you earlier. This incremental information is just simply the relative entropy. And we term that incremental information as a separate empirical measure called accounting classification entropy relative, or ACER. So we have ACE and ACER. ACE captures the total information in accounting classification. ACER captures the incremental information of a new classification relative to the past. So both measures information in classification. All right? So those are the theory foundation I want to tell you. Now let me take them to some empirical tests, right? We get the measure of information in accounting classification. Let's take them to empirical test and see what they make sense empirically. The first step I want to tell you empirically is how these measures can be constructed and computed. And I want to tell you the computation of them is very simple and easy to use, right? So let's compute my ACER measure, which by the way is the incremental information you get from accounting classification. Computation is so simple. Let's take the dollar amount of a financial statement line item. You can get that from a balance sheet. That's your asset value for all your assets, cash balance, account receivable balance, and so on and so forth. And then you convert that dollar balance as a fraction of the total. And then you compute, given the fraction X percentage, you compute the information for that account, which is based on calculation of Acer. It's just the current X percentage divided by the prior period percentage, X percentage T minus 1. So this is essentially just your expectation, right? Remember, it's an incremental information measure. You're comparing the information today to some past reference point. So you just divide that by your past. You take the log, you weight that by some percentage of X, and you get this IX percentage. They just add them up. See, all these calculations, you can easily program them, and you get your Acer measure. Let me give you a more specific example how you can do it, right? Let's say we think about simplest Acer calculation just based on assets. As you can probably see, you can also apply that to liabilities. You can apply Acer to stockholder equities or any other classification as long as they add up to a total, right? So let me do assets. For asset classifications, you can think of 8 very standardized assets, items: cash, receivable, inventory, and other current assets, and 4 other non-current assets: PP&E, intangible, long-term investments, and other non-current assets. You can take these 8 assets, get their dollar value, convert them into fractions, then compute my Acer measure. And also for compute of Acer measure, you need a reference point because it's an incremental information measure, right? For our very simple example, we just pick relative current quarter Q minus 4 as my reference point. So essentially we assume when I see a new set of classification, my benchmark, my prior expectation will just be the balance sheets I had 4 quarters ago. So essentially, I'm assuming a forecasting model for balance sheets as a random seasonal walk. But you don't have to limit yourself. That's also the flexibility or simplicity of our measure. You can choose any other way to form expectations about classification that you want. If you don't like seasonal random walk, you can do just last year's, or last quarter's classification, or you can do anything else, right? So that's the measure you can calculate. It's very flexible. You can change what kind of classification you want. You can change how you want to form as a basis or reference point. All right. So once you get that, let me first show you a first empirical data graph. Remember, I talked about SVB's example, right? We said if you look at the asset section of SVB, you can think about the total asset growth. You can think about classificational information for SVB for the year of 2020 to 2022. And let's see how you use our Acer measure, relative entropy information measure, to capture what's going on in SVB's assets. Let me show you 2 data points. Think about the change in SVB from 2020 to 2021. And this graph offers some scattered plots. The x-axis is my Acer measure. The y-axis is my asset growth measure. If you look at just asset growth, from 2020 to 2021, SVB had a phenomenal growth of 83%. So that's a big year of change for SVB, right? Because we know in that year, SVB had lots of mergers, acquisitions, a lot of development going on. That's a big year of change. And you would expect if our Acer measure truly captured information in SVB, it should also be pretty big. Indeed, if you look at our Acer measure, basically the incremental information you get from 2021's asset classification over 2020, the measure also is huge. It's 45%. So this tells us whenever there's a big change at SVB, you also get a big change at our Acer measure. As a counter example, let's look at next year, from 2021 to 2022 for SVB. Remember, from the total asset growth, that was a plain modest year. The total asset growth barely moved. They only grew by 0.23%. Nothing changed. But if you look at our Acer measure, our Acer measure exactly reflected that. Our Acer measure is really small. It's about 0.7%. Basically says if there's not much going on as SVB from 2021 to 2022, then the incremental information or our Acer measure you get from accounting classification is also pretty small. Well, if you look at this graph, that gives us some confidence. Hey, this Acer measure captures some information in balance sheet classification. But obviously, this is just one example. What about some larger scale empirical analysis of Acer. Does that make sense? Does this measure of information make sense in a bigger sample? Well, we did that for a bigger sample of firms. In fact, the population of public companies as the United States, and we tried to test the relationship between Acer, our information measure, between different market indicators. So this is a regression that we did. So on the right-hand side of the equation, we put in our Acer measure, and we put in a bunch of controls. On the left-hand side of the regression, we put in some market variables. We think about two types or two kinds of market variables. One is the absolute value of the accumulated abnormal return, basically how much return change I'm getting. See, I'm putting in the absolute value of the accumulated abnormal return because our Acer measure is an information measure. It's unsigned, it's not directed, it only can be positive. So it does not distinguish between bad news or good news. Therefore, I also just want to capture the magnitude in my abnormal return. That's why I took the absolute value of it, and this just captures the size or magnitude of abnormal return. Intuitively, you would say if the Acer measure really captures information I'm getting from accounting classification, then whenever this measure of information is bigger, the stock market return in terms of absolute value should also be bigger. And the second market indicator that we use is the trading volume, also within a short window of 0 to 3 days after the release of 10K or 10Q, right? Also intuitively, we would say we would hypothesize that if our measure of information Acer really captures information, then when this information measure get bigger, you should also see bigger trading volume change, right? But let's see what that happens. What do we get? Because who knows? If I look at a table, this is a table showing you the regression between our return measure, the absolute value of the abnormal return, against the Acer measure. At the raw regression, we just do a bivariate regression without any controls, and you see a strong positive association between the stock returns and our information measure. This encouraging because it says we get more information as the Acer measure, well, you get a bigger magnitude in stock returns. Stock returns move when you have information. That's good. But then you may say, let's twist these results. Let's put in some controls. All right, in column 2, we put in controls. The regression results still there. We still have a positive association. I want to comment, this result is there even though we have controlled for, this is the earnings surprise measure. We put in the earnings surprise. We're saying conditional on the earnings surprise, we still get a positive association between stock returns and our Acer measure. So changes in earnings surprise does not fully explain our positive association between Acer and abnormal return. How about twist the result even more? We're putting quarter fixed effects, putting firm fixed effects. As you can see, the 3 stars still stay here. We still get some strong positive association between the return and the Acer information measure. What about trading volume, right? Trading volume is another market indicator that we want to analyze and test whether it has some correlation or association with our information measure. Intuitive again, we anticipate if you do get more information coming out of the balance sheets in terms of an Acer measure, you should also get a bigger trading volume. Well, indeed, if you look at just bivariate without any control regression, well, we get a strong, significant association between trading volume and the Acer measure. You put in controls, especially putting earnings surprises, well, you also get a strong positive association between trading volume and Acer information measure. Putting fixed effects in column 3 and 4 for both quarter fixed effects and firm fixed effects, we still get association across them, right? So that's give us confidence our measure does captures something about information because it's reflected in trading volume and in stock returns. Obviously, we did a bit more in our paper, but in the interest of time, I will just limit my test to trading volume and stock return here. I will be happy to share more in our discussion if you want more discussion of this. before I end my talk, let me just show you one more, right? Because you may say, hey, this ACER measure is nice, maybe, because it captures and reflects some information. It's an information measure. But how can we use it? Can you demonstrate some ways to use this or apply this ACER measure? Well, we have thought about a few ways to apply this measure. The one way that I want to show you today, just one application I want to share with you today, is application on analyst coverage. And this is the scenario or question that we believe our measure can help to address. Think about the following question. We have a bunch of analysts. Analysts always have limited ability or capacities to process all firms' financial statements because they cannot, they're pretty busy. They cannot analyze financial statements of every single firm. That's why analysts often have to choose and pick and prioritize which financial statement or which firm I want to follow and analyze. And the question we want to ask is, how do analysts allocate their processing capacities across different firms in response to the amount of information in those financial statements? And if you think about that question, you may say intuitively or by conventional wisdom, it should be that if I were an analyst, I would allocate more attention, more processing capacity to accounting reports with more information, because that makes sense, right? If there's a financial statements with way more information for me to process and analyze, well, I should allocate more attention just to that reports. Makes sense, right? But then obviously you can think of attention here because there could be adjustment costs, there could be agency conflict that may prevent our analysts from making their coverage or processing decisions in an informationally optimal fashion. So it's ultimately an empirical question on whether analysts do allocate more attention to firms with more informative financial statements, right? So let's test that empirically. But then if you start thinking about that question, well, you need measures, right? You need to measure analyst coverage decision, but more importantly, you want to measure the information in financial statements. So what's the measure for information in financial statements? Well, ideally, if you think of a measure of information, you want to have a measure that the information to be processed. You don't want a measure that may include information that's already been processed, because then that measure will include both information and processing, so it's a mixed bag. It's not clean. You will get reverse causality and everything. And in that regard, we believe our ACER measure, which is an internal measure that's constructed only based on accounting numbers, so it's insulated from any processing yet, because analysts has not even entered the game yet. It's just some internally constructed accounting numbers. It can be very suitable for analyzing the processing question. So if we put in my regression, I put in ACER as my information of balance sheet measure. I put in some analyst coverage proxies on as a dependent variable. That regress that and see whether information in financial statements really affects analyst coverage. So we have done a few proxies for analyst coverage. Our first measure, APC, is a summary measure of analyst coverage, which essentially is the number of unique combinations of the number of analysts times the number of forecasting periods made by the analyst and the number of revisions made by that analyst. So bigger the number, well, that means the bigger the coverage for that particular firm. And we can also decompose this summary measure of analyst coverage into 3 sub-measures. NA is the number of unique analysts covering the firm. So the bigger this number, that means for any particular firm, there's just more analysts covering that firm. And the second measure, PER, it basically measures for a particular analyst the number of forecasting periods made by the analyst. For example, analysts, even for a given firm, analysts can choose to make multiple forecasts. Analysts can choose to forecast the earnings in the next quarter, in 2 quarters, or in a year. In that case, analysts will be making 3 number of forecasts for the same firm. So in some sense, that captures the scope of forecast for the analyst. And the third dimension will be the revisions analysts make. Because for any particular forecast analysts made, analysts can also revise that forecast multiple times, reflecting the processing of information. So in some sense, this revision variable captures the intensity of analyst forecast. analysts can be really intense in using information and processing information for any particular forecast. The bigger the number, that means the analyst is more intense in processing that firm's information, right? So this now, given all these measures of analyst coverage, let me regress this forecast or analyst coverage on my information. Again, my hypothesis will be if analysts have anticipated more information coming out of firm's financial statements, analysts will try to process that firm's financial statements more. Well, what about tables? So this is the table we get. If you look at the summary measure of information of coverage by the analyst, APC, well, you get a positive association here. That is, whenever we get a bigger information measure, ASA measure, in terms of balance sheet information, analysts will try to put more coverage on that firm. And what about the components of this coverage measure of analysts? Well, we look at the three components of it. This is the number of analysts covering the firm. This is the number of forecasting periods or scope of forecast. This is the number of revisions analysts made for any forecast or intensity of forecast. If you look at the result here, well, this result will say, hey, for the number of analysts, the result is just marginally significant at 10%. Basically, this says when information on my balance sheet get more informative, the number of analysts following that firm does not change too significantly. It's still significant, but not that significant. But if you look at the scope of forecast, that is the number of forecasting periods, well, that's increased pretty significantly in response to the information measure. So analysts increase the number of forecasting periods or their forecasting scope. And also, if you look at revision, that's the intensity of changing their forecast. Well, that's also 3 stars significant. That is, analysts also change their intense or frequency of revision when they see a firm has more information coming out of financial statements. So overall, our empirical result supports the hypothesis that analysts will try to allocate more attention in terms of scope and in terms of the forecasting intensity to more informative financial statements. All right, so those are some of the tables I want to share with you, some of the theory I will share with you. Let me now give you a sort of an overview, a takeaway of the paper, and then I'm happy to answer your questions. And in this paper, we try to extend the pioneering work by Shannon, Yuji Ijiri, and Henri Thiel in applying information theory to analyze accounting classification. We did 2 things. We theoretically analyze a representation of accounting classification, and we apply information theory to it. And after our theoretical analysis, we get an entropy-based measure, ACE, that can serve as a summary measure of information in accounting classification with a number of desirable properties that we like. Once we get our measure, then we deploy our ACE measure to empirical analysis, and we apply them to contemporary empirical settings, and we got some success so far. And I want to conclude this presentation with the following quote from Chris Sims, a Nobel laureate who won Nobel Prize in 2003 based on his phenomenal seminal work in rational inattention. By the way, Chris was the first one applied information theory and entropy to the field of economics. Chris did see the potential of applying information theory to economics, and he said it's probably worthwhile to work on this a little bit further. We were inspired by Chris' quote, and we hope it's maybe probably worthwhile for us to work on this application of entropy to accounting a little bit further. So thank you so much for your time. That's all I want to say.
Thank you very much, Professor Chang, for your contribution and your effort. And thank you very much for this excellent presentation, excellent paper. Now, if anyone have any questions, you can open your mic and ask your question.
Good evening.
Yes.
Hello.
Hello. I'm Dr. Nadia from University of Jeddah, Saudi Arabia. Thank you very much for your amazing presentation and this very inspiring topic. I have just one question that comes from my curiosity. Do you think that the Acer measure entraves the faithful representation of financial statements?
I'm sorry, Acer measure affects affect what? Of financial
The
statements?
faithful representation of financial statements.
That's a beautiful question. So first of all, you can probably see the measure is just a pure information measure. So we only look at the representation of it. We don't look into how you get those measures. And you think a bigger problem, why you get sort of this information? Well, this may come from managers' manipulation decisions or auditors' auditing decisions that multiple component that determines Acer measure. You could see, hey, you get a big change of information coming out of it, maybe because some faithfulness issue. So in that sense, it's maybe useful to decompose our measure or analyze it further, say, is this change in the measure driven more by faithfulness issue or driven by auditing or driven by improvement in accounting standards? I can think of a few drivers of it, but obviously we have not done anything. But I would say theoretically, those are all determinants of the change in this measure. So maybe do some analysis of it, maybe get some measures of faithfulness, do some association or regression, and see whether that can drive it. I don't know. I thought that a phenomenal, a beautiful question that's maybe you can do.
Thank you. Because I think that when you said that this measure is internally made by the company, so the management can tailorize the financial statements according to the users. And it's not a big deal for them when they want to respect the disclosure, when they have to disclose according to the IFRS.
No. Obviously, IFRS will be a big chunk of it because they have aligned the actions somehow with the standards. But obviously, I completely agree with you. They have discretion. They can do something they like, not necessarily because of inflation, maybe because they want to do something good for the information angle. But our measure will not speak to that yet because that requires you, as I said, decompose that into different dimensions. It's just a summary measure of information that you can play with. Maybe that will be the application, right?
Okay, thank you. Did you find which is the more impactful information by using the Acer method to users?
Did I find what to the users?
The most impactful informations or class of information that affects the decision of users.
Oh, so most impactful. I don't know which one is most impactful because we have not run all the examples. But then, as I showed you, I've found a particularly interesting way to do this is look at financial analyst. We also did an example of compensation contract. You can look into how this measure would affect compensation contracts because basically this is just an information measure, and it's way to be explored on where this information measure is going to shine most. So I don't know. We just tried a few applications. We don't have enough result to comment on the most impactful of it yet.
Okay, thank you.
Are there another questions? If anyone have any questions, you can open your mic and ask your questions. Aida, you have a question? You can open your mic and ask your question. I think there are some questions in the chat. I asked what can these methods be applied to income statement?
And this method, yes. So as you can see, this is just classification, right? We talk about the classification into assets. It can be classification into revenue. For example, you can decompose revenue into many things. You can decompose expense in many things. That's just a classification on your income statement. The only thing we need is just convert these balances into percentages. I think you can definitely do that in income statement. In fact, I mentioned Henri Thal in his application, even in 1969, he already did that for income statement. He just did that just for one firm, as you can probably imagine in 69. But absolutely, you can apply that to anything. Maybe not even just financial statement numbers. You can even apply that, I don't know, to emission reporting. When you think about climate reporting, you classified emissions into scope 1, 2, 3, and within scope 3 have many other scopes. If you get data on that, you can use this measure to analyze classification of emissions as well. So I would say as long as it's classificational information, you have the license to do it.
There are another questions. If any of you know questions, you can open your mic and ask your questions. Someone asked about the economic significance of the result.
Economic significance. I can give you. Let me show you. I don't remember the economic significance on top of my head, but I can look for the paper and give an answer. Give me 1 sec. I will go to the paper. Okay. So for the return results, for example, let me just give one example. We can talk more. For the return example, we look at the economic magnitude of changing the ASR measure on the return. And the economic significance is that if you just have 1 decile rank increase in the ASR measure, it's that associated with about 0.2% of return change. And I have more. I can, if you email me, I will share all the details with you.
Thank you. Are there other questions? Dear Professor Zhang, what do you suggest for future research in this area?
I'm sorry. Say it again.
What you suggest for future research?
Suggestions for future research.
Yeah.
Okay. But for future research, I think basically you can do a lot of things, because what we tell, for example, you get a measure, you can apply the measure to other set of data I already mentioned. You have the license to apply that to anything that belongs to classification. And I believe classification is everywhere, not just in financial statements, and also in sustainability reporting, and also look at proxy statement. I think we also did a application to analyzing the pay structure, because you think about the pay to CEOs is also have a bunch of components. It can be bonuses, options, cash, and everything. That's also a classification. You can analyze, you can apply the measure to that. That's one application I can think of. Second, once you get the measure, it's an information. And we do know from information economics now, information affects a lot of things. It affects, like Nadia said, it affects manipulation, it could affect auditing, it could affect investments, it could affect trading. I mean, this is just your independent variable. You can find a dependent variable that fits your research taste, and I think that it's just so many unlimited ways to do it.
Thank you very much. Are there other questions? If anyone have any questions, you can open your mic and ask your questions. If anyone have any questions, you can open your mic and ask your question. There are questions about the indigeneity problem.
Question about what?
Indigeneity.
Indigeneity. That's a beautiful question. So as I said, this is not a paper about causality or anything. What I'm doing here is just pure association analysis, because this is a paper I'm trying to theoretically prove a measure and show you some association between this measure with many other things. Obviously, we have done the bells whistles to adjust some of that empirical issues. We have added fixed effects, we added controls and other things. But there's no causality here at all. We are not claiming causality on any of these results. Think of this like a theorists give you some measures, and we have done some validation tests of it. It makes sense. And then if you want to use that for your own research question as a measure, well, you should be careful about indulging those research. But this paper has no intention to do a causality or anything like that in this paper. Just a measure and association test.
Okay, thank you. If anyone have any questions, you can open your mic and ask your question. If you have any questions, you can open your mic and ask your question. Thank you very much, Professor Zhang, for your contribution and your effort. It's really an excellent presentation, excellent paper. Thank you, everyone, joining us today, and thank you very much for taking the time to present to us. It's been appreciated, dear Professor Zhang.
Thank you, Mohammed. Thank you for the opportunity. Good to see everyone. Okay, thank you.
And I hope to see you soon in Egypt. You are very, very welcome.
Thank you. Look forward to that.